Welcome to Breaking News to Trading Moves. We're looking at a headline today that's, well, it's very specific, very numbers-driven, and it cuts right to the heart of the critical minerals sector.
It does. We're talking about the United States government backing a $1.6 billion package. And it's for one specific company, USA Rare Earth.
Okay, so let's see the details out right away. The company is USA Rare Earth, and the ticker for anyone tracking at home.
That's USAR. And this package, it's not a simple grant. It's a mix of debt and equity financing.
Oh, mix.
Yes. And the capital is very clearly earmarked. It's for building two major physical assets. First, a rare earth mine down in Texas. And second, a magnet manufacturing facility, which is slated for Oklahoma.
A mine and a factory, so the whole supply chain, from dirt to magnet.
That's the idea. But, the detail that really makes you stop and read the filing twice is the structure of the deal itself.
Go on.
The Department of Commerce is set to take a 10% equity stake in the project.
Okay, now that is the detail that makes this different. We're not talking about a loan guarantee, which we see all the time.
Right. Or a simple grant from an infrastructure bill.
This is ownership. The U.S. government is buying shares in a mining project.
Exactly. It's a direct equity injection. And the policy goal behind it all is very explicit in the announcement. This is a deliberate push to cut the U.S. reliance on China for these strategic materials.
And for our discussion today, we're not here to debate the politics of that or the philosophy of government ownership.
No, not at all. Our goal, our mission, is much more focused. We want to walk through this headline piece by piece. We need to identify the potential winners and, just as important, identify the potential losers.
And then finish up by looking at what you, the listener, need to watch next to see how this plays out in the market.
Precisely.
So let's set the tone. We are keeping this factual. We're going to focus on the mechanics of the deal, the money, the assets, and the immediate market reaction.
Agreed. Let's look at the raw data and what it implies for trading. No hype, just the mechanics.
Okay. Before we get into the individual company names, the winners and the losers, we really have to set the context for the market. Why does this transaction matter so much? Why is the Department of Commerce getting out its checkbook for a mine in Texas?
It all comes down to a concept called strategic choke points.
Choke points?
Yeah. When we talk about rare earths, and specifically permanent magnets made from them, we're not talking about something optional. We're talking about the essential physical inputs for, well, almost all modern high-tech industry.
So give us some examples. Where do you find these things?
You find them everywhere. They are critical components for fighter jets, especially in the stealth coatings and advanced sensor systems. They're in missile guidance systems, allowing for that incredible precision.
Okay, so defense is a big one.
A huge one.
Yeah.
But it's also commercial. The high-torque electric motors in practically every EV on the road, they depend on these magnets. The giant generators and wind turbines, same thing. And then you have consumer electronic speakers, hard drives, the little haptic motors in your phone.
And the choke point, as you called it, is that the supply chain for all of those magnets is extremely concentrated right now.
It's more than concentrated. It's almost entirely dominated by China. From the mining of the ores to the complex processing and finally to the manufacturing of the magnets themselves, that is the choke point.
So the government's role here with this $1.6 billion is to try and, break that choke point?
The technical term they would use is de-risking. When the government steps in with capital, and again, the key here is that it's equity capital, it accomplishes two main things.
Okay, what's the first one?
First, it pulls forward timelines dramatically. Mining projects, especially in the U.S., can take a decade or more just to get financed and permitted. It's a long, arduous process.
I can imagine.
With $1 billion-plus government backstop, you can start ordering equipment, hiring engineers, and moving dirt much, much faster. It collapses the timeline.
Okay, that makes sense. It's an accelerator. What's the second thing?
The second thing is a market phenomenon that we call re-rating.
Re-rating.
Yes. So imagine you're an investor. You're looking at this whole sector of fledgling domestic supply chain companies. You see, the U.S. government is not just lending the money, but is willing to be a shareholder and owner alongside you. What does that do?
It tells you the project probably isn't going to go bankrupt.
Exactly. The risk premium you would normally attach to a small mining company just evaporates. So you start to value these companies higher, their multiples expand, the entire sector gets a re-rating because the existential risk, the risk of failure, has been substantially reduced.
So that's the setup. You've got the strategic necessity, this choke point, meeting a massive injection of government capital. That brings us to the winners. It seems like we can break them down into three distinct categories.
That's right. And the first category is the most direct, the most obvious one. We're
Yep.
talking about U.S. rare earth production and processing companies.
The ones that are literally in the business of digging and refining.
These are the direct beneficiaries. The whole theme is reshoring, bringing this capability back to the U.S. The trade logic couldn't be simpler. If the government is writing checks for this kind of work, these are the companies that will be cashing them.
And obviously, we have to start with the company that's right in the headline, USA Rare Earth, ticker USAR.
Right. USAR is the primary recipient. They are getting the full $1.6 billion package. For a company at their stage of development, this isn't just helpful, it's total validation.
What do you mean by validation?
Well, think about it. Until you have the capital secured, a mine is just a plan. It's a geological report, some core samples, a bunch of PowerPoint slides. It's an idea,
An expensive idea.
a very expensive idea. This funding allows them to actually break ground on the Texas mine. And, just as critically, it allows them to build out that magnet plant in Oklahoma. The trade logic for USAR is that they have just been fully funded all the way to production.
So it basically removes that huge financing overhang that almost always suppresses the stock price of a junior mining company.
Precisely. That's the key risk for any investor in this space. You're constantly worried about dilution. You're worried the company will have to issue millions of new shares at low prices just to pay for the first bulldozer or the first feasibility study.
And here, the government is providing that capital instead.
The government is stepping in to fill that gap. It's an enormous vote of confidence, not just in the management team, but in the quality of the asset itself, in the geology of that Texas deposit.
But they aren't the only ones in this bucket. The market doesn't operate in a vacuum. It moves in sympathy. So let's talk about another name, MP Materials, ticker MP.
MP Materials is a really important one to discuss. They are currently the largest producer of rare earth materials in the entire Western Hemisphere. They operate out of the historic Mountain Pass mine in California.
So they're already up and running. They're the incumbent, in a way.
They are. And they didn't get any of the specific money from this deal. But the trade logic for MMP is what we call a sympathy play.
How does that work? Why would a competitor getting $1 billion be good for them?
Because it validates the entire sector.
Hmm.
Think about it from a big institutional investor's point of view. If the government is willing to pump this kind of money into USAR, it signals a long-term, strategic commitment to building a domestic rare earth ecosystem.
It's not just a one-off project.
It's not just one company trying to swim upstream against the global market. It's a government-backed national initiative. And it's worth noting, MP has also been building out their own downstream magnetics capability, also in Texas. This deal for their competitor actually improves investor confidence that the broader supply chain build-out is real and has federal support.
So it validates the whole thesis that domestic production is a national priority.
It does. It tells the market that the U.S. is serious about having multiple nodes of production, multiple companies. They don't want to replace a single foreign choke point with a single domestic one. If USAR is the government's chosen partner for this project, it also implicitly lowers the regulatory and political risk for MP as well. It implies that the overall regulatory environment for domestic mining of strategic minerals will remain friendly. The permitting agencies are likely to be encouraged to, well, to move things along for projects that are seen as contributing to this national goal.
And that logic extends to the third name in this category, right? Energy Fuels. The ticker is UUU.
Yes, Energy Fuels. Now, they are primarily known in the market as a uranium company. That's their core business. But over the last few years, they have been very aggressively and cleverly moving into rare earth processing.
Processing, not mining.
Correct. They are leveraging their existing asset, the White Mesa Mill in Utah, which is the only licensed and operating conventional uranium mill in the country. And it turns out the same infrastructure can be used to process rare earth elements.
So the trade logic for them is similar to MP.
Very similar. They are a beneficiary of that same improved confidence. If the Department of Commerce is buying equity in mines, it means that the processing capacity that Energy Fuels offers is going to be in very high demand. You can't have a mine without a mill to process the ore.
There's sort of the picks and shovels play on the processing side of this trend.
That is a perfect analogy. The White Mesa Mill is also unique because it's equipped to handle the radioactive elements, like thorium, that often come out of the ground alongside rare earths in many deposits.
Which can be a major headache for other processors.
A major technical and regulatory headache. So if the U.S. is serious about ramping up domestic mining, All of that ore has to go somewhere to be separated and refined. Energy Fuels is positioning itself as that critical midstream destination. This funding for USAR strongly suggests there's going to be plenty of ore to go around for them to process.
Okay, so that's our first group of winners, the producers and the processors. The companies actually digging the stuff up or refining it. Now, the second category of winners is a little more abstract, but potentially just as profitable for investors who see the pattern. We're calling this group U.S. critical minerals developers.
That's right. And the theme here, the concept you need to grasp, is policy capital.
Explain that term for us. Policy capital.
Policy capital is the value a company derives simply from being aligned with stated government policy goals. This deal, with the government taking an equity stake, sets a brand new precedent. It's not a loan guarantee, it's ownership.
So the implication is they might do it again.
Exactly. The market starts to think, if they're willing to do this for rare earths, what other critical minerals might they do this for? It lifts the potential valuation for the entire critical minerals complex. Any company with a quality asset in a strategic mineral suddenly has a new potential source of funding.
Okay, so who fits that description? Let's get into some names.
Let's start with a big one. Lithium Americas. The ticker is LAC. They are in the process of developing a massive lithium deposit in Nevada called Thacker Pass.
And lithium is arguably just as critical for the energy transition and national security as rare earths.
Absolutely.
Yeah.
You can't have EVs without lithium batteries. You can't have grid-scale energy storage without them. The trade logic for LAC is the potential for similar government support. If the Commerce Department is acting like a strategic venture capitalist for rare earths, investors will immediately start to speculate that they might do the same thing for a Tier 1 lithium project on U.S. soil.
It becomes a pattern recognition trade for the market.
It's exactly that. Investors are looking at the critical minerals map of the U.S., and they're saying, okay, the government just moved to secure the magnet supply chain. What's the next logical move? Batteries are the obvious answer. And LAC is sitting on one of the largest known lithium assets in the entire country.
So it puts a sort of a theoretical government put option under the stock price.
That's a great way to think about it. The perceived downside risk is lowered because there's this new possibility of a major government partner stepping in if the project runs into financing trouble.
Okay, another name that fits this theme is Trilogy Metals, ticker TMQ. They're focused up in Alaska, in the Ambler Mining District. What are they looking for?
They're focused on copper, zinc, and cobalt, all of which are also on the strategic materials list.
Right. Copper for electrification and the others for alloys and batteries.
Precisely. Copper is the metal of electrification. You need it for wiring, for motors, for everything. Zinc and cobalt are vital for advanced alloys and battery chemistries. The Ambler District is known to be very high grade, but it has one major challenge.
It's remote.
Very remote. It needs infrastructure. Specifically, it needs a road.
And building a road in the Alaskan wilderness is not simple or cheap.
No, it's incredibly expensive and politically complex. But a company like TMQ benefits from the precedent set by this USAR deal. If you're holding TMQ stock, you're looking at this news and thinking, okay, the federal government is getting serious about securing domestic resources wherever they are.
So it reduces the perceived political risk of getting something like that road permitted and built.
It does. If the federal government is acting as an investment partner in the sector, it suggests they'll also be a partner in getting the necessary infrastructure and permits approved for other strategic projects. It changes the political calculus.
And what about the third one in this policy capital bucket?
Neocorp Developments. The ticker is NOB. They are developing a project called Elk Creek in Nebraska.
Nebraska. You don't usually think of mining in Nebraska.
No, but this is a very unique deposit. It contains niobium, scandium, and titanium. Again, all materials with major applications in aerospace and defense.
Niobium is used to make high-strength steel alloys, correct?
Yes, it makes steel lighter and stronger at the same time. It's essential for high-performance pipelines, bridges, and lighter vehicle chassis. Scandium is used to create super-strong aluminum alloys for aerospace.
So the logic for Neocorp is similar to the others.
Yes. The trade logic is that this news reinforces the value of having these kinds of strategic projects on U.S. soil. Neocorp has been working on its financing package for a long time. This news about USAR suggests that the financing window for projects like theirs might just be opening wider. The government has now shown it has an appetite and a checkbook for exactly this type of strategic materials project.
So we have the miners and processors, and we have the developers who might be next in line. That brings us to our third category of winners, which is maybe the most intuitive, the end customers, the people who actually need these magnets. We're looking at the defense and aerospace primes.
Right. The theme here is simple. Supply chain security. If you are a company like Lockheed Martin and you're building a multi-billion-dollar fighter jet, your biggest operational nightmare is having your production line shut down because you can't get a $100 part.
And a secure U.S. magnet supply chain reduces that procurement risk.
It dramatically reduces it. And you have to remember, these companies work on incredibly long cycles.
Decades in some cases.
Absolutely. They are planning and sourcing for production runs that will be happening in the 2030s and 2040s. This kind of government funding gives them much higher confidence in their ability to meet those long-term production schedules without disruption.
Okay, so let's name names. The biggest of the big. Lockheed Martin, ticker LMT.
LMT. They make the F-35 fighter jet, which is one of the most complex machines ever built. The F-35 is absolutely loaded with rare earth magnets. They're in the electric motors that control the flight surfaces. They're in the advanced radar and sensor systems. They're in the actuators.
And right now, the supply chain for those is precarious.
It is. If they have to source those critical magnets from a potential adversary, that's a massive national security risk. If they can get a guarantee that they can source identical, high-quality magnets from a plant in Oklahoma run by a company partially owned by the U.S. government, well, that risk just evaporates.
So for Lockheed, secure supply means less disruption.
Less disruption, which means better cost control, better margins, and more reliable delivery schedules to their primary customer, the Pentagon. It's all about predictability.
Right. Defense contracting is all about hitting your milestones on time and on budget.
It is. If you miss a milestone because you can't get a magnet, you don't get your progress payment, or worse, you face financial penalties. Removing that key variable from the equation is a direct win for their balance sheet.
Okay, next up in this group, RTX, ticker RTX. Most people would know them as the merged Raytheon and United Technologies.
RTX is a giant in missiles, missile defense, and advanced sensor systems. The trade logic for them is exactly the same as for Lockheed. They have an extremely heavy reliance on high-tech, multi-tiered supply chains.
And they need a guarantee of supply for things like guidance systems.
For guidance systems, for radar arrays, for all the sensitive electronics, this deal provides a path to that guarantee. When they go to bid on future government contracts, they can now say with a high degree of confidence that their critical magnet supply chain is secure and entirely domestic. That is a real competitive advantage over rivals who can't make the same claim.
And the final name in this defense bucket, Northrop Grumman, ticker NOC.
NOC. They are the builders of the new B-21 Raider stealth bomber, among many other platforms. Extremely complex, long-cycle defense hardware. They are a primary beneficiary of this reduced risk.
How so?
Because when the government steps in to ensure the raw materials are available domestically, it essentially subsidizes the risk profile of these prime contractors. They don't have to worry about vertically integrating and building a mine themselves.
Which they would never do anyway.
Of course not. But they do have to worry about their suppliers. The government is now paying someone else, USAR, to build that supply chain for them. It allows Northrop to focus on what they do best, designing and assembling these incredibly advanced systems.
Okay, so those are the winners. We've got the producers, the developers, and the defense primes. But as you know, in every trade, for every winner, there has to be another side to the story. Let's talk about the losers.
Right. It's just as important to look at who might be negatively affected by this pivot in U.S. policy.
And the first group of potential losers seems pretty clear. The China EV ADRs. These are the Chinese electric vehicle companies that are listed on U.S. exchanges.
That's right. And the theme here is their acute sensitivity to what we call decoupling headlines.
Because this deal isn't just about mining, it's an explicit geopolitical statement about cutting reliance on China.
Correct. The U.S. government's strategic push to build a parallel, non-Chinese supply chain for critical inputs creates what's known as headline risk for these companies. Even if their operations aren't immediately affected, the sentiment around their stocks can sour.
And it raises the possibility of further trade tensions.
It does. It brings back the specter of potential new tariffs or supply chain restrictions that could go both ways. China could retaliate with their own export controls, for example. It just adds a layer of uncertainty.
So let's take a name like NIO, ticker NIO. How does this affect them?
NIO is very exposed to these sentiment shifts regarding U.S.-China technology decoupling. If the U.S. government is putting billions of dollars into building its own supply chain, it implies a hardening of the U.S. stance. For a U.S. investor, that makes holding an ADR like NIO feel riskier. It suggests the two technology and financial markets are drifting further apart, not closer together.
And is it the same story for a company like Li Auto, ticker LLM?
LEI, yes. The logic is very similar. Operationally, they're executing quite well. They're selling a lot of cars in the Chinese domestic market. But their stock price, which trades in New York, often moves more on geopolitical friction than on their quarterly sales numbers. This news is a form of friction. It's a stark reminder to investors that there's a macro-level struggle happening completely outside of the company's control.
And the third of the big three, XPeng, ticker XPEV.
XPEV faces that same negative pressure from the narrative. The story in the market becomes the U.S. is actively trying to wall off its EV supply chain from China. Even if XPeng's day-to-day business isn't immediately impacted, that narrative makes these stocks less attractive to large institutional funds.
Why is that?
Because big pools of institutional money absolutely hate uncertainty. They fear future sanctions, or worse, a forced delisting from U.S. exchanges down the road. This deal adds another layer of uncertainty to that long-term relationship.
Okay, so that covers the geopolitical losers. Now let's look at a group that's a bit more operational. We have the OEMs, the original equipment manufacturers. We're talking about the big U.S. automakers.
This one feels a little counterintuitive at first, doesn't it? You would think that having a secure domestic supply of magnets would be a good thing for Ford and GM.
And long-term, it probably is.
Long-term, yes. But the theme here is exposure to near-term supply tightness and something called requalification risk.
Okay, you have to explain requalification risk.
Sure. If you're an automotive engineer, you can't just take a magnet made in China out of a motor and swap in a new one made in Oklahoma and call it a day. It doesn't work like
It's
that.
not a commodity part.
Not at all. You have to rigorously test the new magnet. You have to certify that it performs exactly the same under all conditions: heat, cold, vibration, stress. That testing and certification process takes a lot of time and a lot of money. That's requalification risk.
And there's this transition period until the U.S. capacity actually ramps up and is producing at scale, which will take years. There is a potential supply gap.
A very dangerous gap. During that period, if geopolitical tensions rise, the existing supply from China might get tight or more expensive.
So this move, while aimed at long-term security, actually creates short-term friction.
Yes, high friction. It can mean higher costs, major headaches from switching suppliers, and a lot of work for the engineering teams to validate that the new domestic magnets perform exactly as needed.
Let's look at Ford, ticker F. They've bet the farm on EVs like the Mustang Mach-E and the F-150 Lightning.
Ford has made a very heavy investment in EVs, and all those EV motors require a lot of these high-performance magnets. If the global supply chain fractures before the Texas mine and Oklahoma plant are ready, Ford could find itself in a very tough spot.
So it's an operational risk for them?
It's a major operational risk. They're trying desperately to scale up production and lower their costs to compete. A sudden disruption in the magnet supply does the exact opposite. It could lead to production slowdowns and increased costs per vehicle.
And the story is similar for General Motors, ticker GM.
Very similar to Ford. GM, with its Ultium battery platform, is also all in on EVs. They are exposed to those same potential cost increases. If they are forced by regulation or circumstance to buy compliant domestic magnets before the U.S. producers have achieved scale, the price will be higher.
And that squeezes their margins.
It squeezes margins on EVs that are already, in many cases, very thin or even unprofitable. They might have to pay a significant premium for made-in-USA magnets just to meet regulatory requirements or to de-risk their supply chain. And that cost has to come from somewhere.
We also have a non-automotive name in this bucket, GE Vernova, ticker GEV.
GEV. This is the big energy-focused company that recently spun off from General Electric.
Yeah.
It's a huge part of their business is building wind turbines.
And wind turbines use massive magnets.
Absolutely massive. Much, much larger than what goes into an electric car. For them, any supply tightness in the magnet market affects their production costs directly and immediately. If the U.S. government starts earmarking the first batches of domestic magnets for defense applications,
Which seems likely.
it seems very likely, that leaves the commercial sectors, like wind energy, potentially fighting for allocation of the remaining supply. That drives up costs and creates a major margin headwind for a company like GE.
That's a crucial point. If there is a limited initial supply of these new domestic magnets, who gets them first?
The defense contractors and anyone with a government mandate will almost certainly get priority. That's how these things usually work. It could leave commercial customers scrambling for supply or paying much higher prices in the near term.
Okay, that brings us to our final category of potential losers: hardware and consumer electronics.
Right. And the theme here is that these products are full of small, rare, earth-heavy components. We're talking about the tiny magnets in speakers, in hard drive actuators, in the haptic engines that make your phone vibrate.
And the concept here is the same as with the automakers. Even if long-term supply security is the goal, the transition itself can be painful and costly.
It's all about compliance costs and component costs. If the U.S. government starts mandating supply chain audits to prove your magnets aren't from a specific country, or if China retaliates with broad export controls on these materials, a company like Apple ticker AAPL faces a massive logistical headache.
Because Apple moves such enormous volume.
The scale is almost unimaginable. Any tiny shift in component costs or logistics gets multiplied by hundreds of millions of devices and has a real impact on their gross margins.
A few cents per iPhone really adds up when you sell 200 million of them.
Exactly. And beyond the cost, think about the administrative burden. The work involved in tracing the precise origin of every milligram of rare earth material in an iPhone is enormous. If the regulatory environment becomes stricter because the U.S. now has a domestic alternative it wants to promote, Apple has to spend a lot more money on compliance and paperwork.
Okay, what about a company like HP, ticker HPQ?
HPQ is exposed through all of its personal computing hardware components. Laptops, for example, use magnets in the screen hinge and the speakers, in the cooling fans and the hard drives. And HP, like most PC makers, operates on razor-thin margins in the hardware business.
So any increase in their input costs hurts them directly.
It goes straight to the bottom line. And unlike a fighter jet or even a premium EV, you can't easily raise the price of a mid-range laptop by $50 to cover the increased costs of a domestic magnet. The consumer PC market is incredibly price-sensitive.
And I assume it's the same story for their biggest competitor, Dell Technologies, ticker DELL.
DELL. It's the exact same story. They face the same exposure to component cost inflation. If they are forced to re-engineer their products, to use non-Chinese magnets, or simply pay a premium for available supply, it hits their bottom line. And the compliance hurdles of proving your supply chain is clean are not cheap. It adds layers of bureaucracy and cost to their entire procurement process.
So we've mapped out the whole battlefield. We have a good sense of who gets the money, who benefits from this policy trend, and who might get squeezed during the transition. The big question now is, what do we look for tomorrow? What are the key indicators we need to watch?
I think there are three critical things to watch next. Number one is the confirmation of the Commerce Department's terms on this deal.
We know the headline number is 1.6 billion, 10% equity, but we need the fine print.
We absolutely need the fine print. We need to see the pricing specifics. At what valuation is the government buying its equity? Are there warrants attached that give them the right to buy more shares later? What are the specific milestones USAR has to hit to get the money?
And does the government get a board seat?
That's a huge question. The governance structure of USAR is going to be seen as a blueprint for any future deals like this. If the government demands a seat on the board, it implies a very active, hands-on level of management and oversight. If they're just a silent financial partner, that sends a very different signal to the market.
Okay, that's indicator one, the terms of the deal. What's number two?
Indicator number two is customer announcements for USA Rare Earth, ticker USARR.
We need to see who actually signs up to buy these new U.S.-made magnets.
Yes, we've speculated about the defense primes and the automakers, but speculation isn't enough. We need to see the press releases announcing signed contracts.
Binding offtake agreements.
Exactly. If Lockheed Martin or General Motors announces a long-term binding offtake agreement with USAR, that cements the entire thesis. It proves that the market demand for this domestic product is real and that major customers are willing to pay the likely domestic premium. An offtake agreement is the ultimate validation of the business model.
And the third and final indicator to watch:
Timeline updates, specifically for the Oklahoma magnet plant and the Texas mine. The government money is meant to pull the timeline forward, but we need to track the actual speed of the build-out.
We need to see action, not just press releases.
That's it. Are they breaking ground next month, next quarter? When do they expect first production?
Speed is the critical variable here because, as we discussed, there's a lot of risk for OEMs during this transition period.
The market needs to know when this new supply will actually come online to fill that potential gap.
Right. A press release announcing funding is one thing. Pouring concrete and commissioning a factory is another thing entirely. We need to watch for tangible, physical progress.
All right, let's wrap this up. We have covered a lot of ground here today.
We have. It's a complex story with a lot of moving parts.
So to quickly recap, the U.S. government is backing a $1.6 billion package for USA Rare Earth, ticker USAR. A key feature is a 10% equity stake being taken by the Commerce Department. And the stated goal is to build a mine in Texas and a magnet plant in Oklahoma, all to secure the U.S. supply chain for critical materials needed for defense and electric vehicles.
The winners appear to be the domestic producers themselves, like USAR and MP, other critical mineral developers like LAC who might be next in line for funding, and the defense primes like LMT who get much-needed supply security.
And the potential losers, at least in the near term, are the Chinese EV ADRs who face geopolitical headwinds, and the U.S. OEMs and electronics makers who could face transition friction, higher costs, and requalification headaches.
And that brings us to our final thought. We always like to leave you with a concept to mull over after the discussion.
I think the big concept to really chew on here is this idea of policy capital. We've touched on it, but think about what it really means. If the U.S. government is now in the business of buying equity stakes in mining companies, does that fundamentally change the valuation model for all other critical mineral projects?
How so?
Well, we are used to valuing these companies based on traditional metrics. The grade of the ore in the ground, the cost to extract it, the global price of the commodity. But now we might have to add a premium for strategic alignment.
So a project's value isn't just about geology anymore, it's also about its politics.
That's the question. If a project in Nevada or Alaska perfectly fits the national security narrative, is it now worth 20% or 30% more simply because the government might eventually become the ultimate financial backstop? It introduces a whole new variable into the math of investing in this entire sector.
A whole new variable in the equation. That is definitely something to think about. Before we go, we have the mandatory disclaimer.
Yes, please remember this is not financial advice. We are not giving buy or sell recommendations. This discussion is purely the opinion of the author and is for informational and educational purposes only. You should always do your own research and consult with a professional.
Thanks for listening to Breaking News to Trading Moves. We will see you on the next one.